You've probably seen the headlines. A 22-year-old drops out of college, pitches an idea on a napkin, and gets handed $10 million by a group of smiling venture capitalists. Most people assume these investors are looking to fund a safe, reliable win, a boutique software agency or a local retail chain, pulling in a healthy $500,000 a year in pure profit. If you pitched that exact business to a top-tier venture firm on Sand Hill Road, they would politely show you the door. That immediate rejection happens because the entire private equity ecosystem operates on a hidden, ruthless mathematical equation called the power law. To understand the power law, you have to look at whose money is actually changing hands. Venture capitalists aren't writing checks from their personal bank accounts. They manage money for huge institutions, pension funds, and university endowments, and they are contractually obligated to deliver massive, outsized returns. This diagram represents a standard venture capital portfolio. Let's say a fund invests in 100 different startups at once. Statistically, the fund managers know exactly what will happen. 60 of those companies will go completely bankrupt, wiping out the initial capital entirely. 30 of the survivors will become zombies, companies that survive but barely break even. Another 9 will generate modest returns. Even if those 9 double or triple the initial investment, it is mathematically impossible to pay back the institutional investors with those profits. Everything, the entire ecosystem, the private jets, the billion-dollar funds, relies entirely on this one remaining company. That single business has to grow so massive and so fast that it pays for its own success, plus the 99 failures combined. This math changes the psychology of the people sitting across the table from you. An investor cannot afford to accept a healthy, sustainable 20% annual growth rate. They have to force founders into an aggressive, unnatural 200% hyper-growth cycle. Taking a venture capital check is not a steady partnership. It is the equivalent of strapping a highly volatile rocket engine to your business, which is statistically likely to blow up your life's work. Because the math requires a moonshot, venture capitalists actively filter out rational, realistic managers. The moment you walk into a pitch meeting, they are scanning for a specific psychological trait: irrational ambition. When Brian Chesky pitched Airbnb, the idea of letting strangers sleep on your air mattress sounded like a massive liability. But his ambition was to build the largest hotel chain in the world without owning a single building. A crazy idea requires a second trait: cult-like conviction. VCs need to know you are magnetic enough to convince a senior engineer at Google to quit their safe, high-paying job and work in a dusty garage for half the pay and a handful of lottery tickets. The final required trait is relentless velocity. If your idea is good, well-funded competitors will try to clone it overnight. Your only defense mechanism against a tech monopoly is how fast you can build, break, learn, and iterate. Let's say you have those 3 traits, and the $10 million wire transfer hits your bank account. An invisible countdown clock immediately starts ticking. In exchange for the cash, you give the investors a seat on your board of directors. Many founders think the board is just a group of friendly advisors. They quickly learn the board is legally their boss, holding the absolute power to fire them from the company they just created. If the required hypergrowth slows down, the investors panic. They will call a vote, declare the company has outgrown you, and force you out. It happened to Steve Jobs, it happened to Travis Kalanick at Uber, and it happens to hundreds of unknown founders every single year. This chart breaks down the ultimate financial trap hidden in your contract, the 1x liquidation preference. In this standard cap table, you sold 20% of your company for $10 million, leaving you with an 80% majority ownership. If the market shifts and a larger tech company offers to buy your startup for a flat $10 million, you naturally do the math. You own 80%, so you assume you walk away with an $8 million payout. But the liquidation preference legally dictates that the investor takes their entire initial $10 million investment back first. Despite holding 80% of the equity, your payout instantly drops to zero. A few years ago, the smartest founders recognized this rigged system. They launched a rebellion demanding super voting shares, a legal hack designed to entirely strip investors of their leverage. Adam Neumann became the ultimate corporate dictator using this exact tactic. When he raised billions for WeWork, he demanded shares carrying 10 to 20 times the voting power of his investors. This made the board mathematically powerless to fire him. Without a board to pull the emergency brake, that unchecked power led to catastrophic cash burn on wave pool companies and private jets. Wall Street eventually looked at the financials, and WeWork's valuation collapsed from $47 billion to pennies on the dollar. Thousands of employees lost their jobs. Because Neumann held all the legal leverage, his lead investor was forced to pay him $1 billion ransom just to step down from the wreckage. This exposes the core paradox of venture capital. When investors hold all the power, perfectly good companies are destroyed in the pursuit of impossible growth. When founders hold all the power, billions of dollars evaporate in an unchecked blaze of ego. The industry is entirely neutral. It is simply a highly tuned mathematical machine built for one specific purpose: hunting for unicorns to satisfy the power law. If you want to build a profitable business, keep your sanity, and own what you create, avoid Sand Hill Road. You should only take venture money if you possess irrational ambition and are willing to accept a 90% chance of destruction. But taking the check isn't the only way to win. There is a different breed of entrepreneurs building billion-dollar empires through bootstrapping. They retain full ownership, with no board members and no liquidation preferences. And the playbook they use to beat VC-backed giants is exactly what we're breaking down next.